or your business dealings. Most of them is probably buying stuff. Okay, so we're going to look at merchandising activities and how costs flow through the business. We're going to, I'm actually not, I shouldn't be saying this on tape, but I'm not actually doing this, all the ratios. We kind of talk about it. I haven't really been testing on them, but we do need to look at something called an acid test ratio and a gross margin ratio to see how well my company is doing if I'm a merchandiser. And then we're going to, of course, learn how to record the transactions. We're going to prepare adjustments and close the accounts. And now we're moving into a more complicated but complete multiple step income statement. Okay, so service companies basically just sell their time, right? I'm a CPA. I'm gearing up for tax season here that's going to start in 2.5 months. I've got 55 clients. They start calling me and like, can you do my taxes? What am I selling them? Yeah, I mean, there's not even a physical product anymore. I'm completely electronic. Scan your stuff and send it to me. I put it into my software. I e-file them and I PDF them a copy of their tax return. I mean, in the old days, I was sitting at the copy shop with stacks of paper, right? And I actually still keep a paper copy for myself, just because I do. But so I don't sell them a tangible product. I sell them revenue. I sell them my time, right? So that's super easy. Generate revenues, subtract my expenses, and really my expenses is like my software charges, my computer, the cost of my home office, blah, blah, blah. And then I get to my net income, right? That's that. Oh my goodness, this looks so much more complicated. Let's just break it down though, because it really isn't. So we're talking about Nordstrom's, and they're saying if you didn't have a multi-step financial statement, does this really tell you anything over here from Nordy's? I mean, I can't see anything. Okay. So let me just back up a second, and I want you guys to, just think about this and read it, fill me in on what you think. What do you think one of the most important things is for a manager of a merchandising company to control? Sorry, loss? Well, certainly loss, but I mean, what's the equation they've constantly got to be thinking about? Yes, profit margin, exactly. So give me an example from your world in cars. So do you have friends, or are you involved in the used car market at all? Okay, you just very narrow targeted focus here. Okay, I was okay. Just work with us here. Okay, so here's the scoop. Used cars is a great example. We have a relationship. My husband is the CFO of the Youth Homes, which is a nonprofit. They have adolescent youth homes all over Western Montana. And so each of the houses has to have a big van, passenger van, to carry the kids everywhere, okay? So Youth Homes has a relationship with Flanagan Motors, right? Old local Missoula car company. And what they do is, I mean, they have new cars, but they also go to auction and they buy used cars and they bring them back here and they may wrench on them a little bit and then they sell them. So what's the most critical thing that he has to do? I mean, in the car world, it's called moving metal. Is he's got to balance what he pays for these things and what he sells them for. Now, if he pays too much for it and he comes back and goes, hey, Lisa, I got this great 2010 Impala that I can sell you for 25 grand. I would be like, dude, you are nuts. I can, I mean, right? So if he paid too much for it, that's really a bummer for him because he's not gonna be able to recoup his costs. And that's a really salient point right now because what's happening in our economy right now? There's quite a lot of upward pressure it's not post-COVID, but because of all the constraints on our supply chain, right? Everything from all the container ships sitting out in the ports of Long Beach that can't come on, and then there's no truckers here to truck them. And I mean, there's a lot of inflationary pressure. So when I go to buy something, the cost has gone up for me. What do I have to do when I turn around and sell it to you? I've got to jack up the price too. Otherwise, I mean, what profit margin I have. And now help me think about this. Think about the income statement. So if I'm Flanagan Motors, I go to Spokane, I go to auction, I buy my cars, I bring them here, I wrench on them a little bit, I sell them. What does the difference between that cost and that revenue have to cover? It has to cover the expenses of wrenching on them. What else? Huh? My travel to Spokane, what else? Taxes. It literally has to cover everything on my P&L, doesn't it? And you know what that is. You know, you start with the, you know, depreciation expense and fuel expense, and you can just interest expense and insurance expense. And you guys can kind of picture what a P&L looks like now, right? So the difference between what I paid for that car and what I sold that car for has to cover all those other things down the P&L and generate net income, right? Because I can't stay in business if I don't have net income. So do you see what they have to manage? This is a much more complicated business to manage, isn't it, than me selling my time as a CPA. I don't have any things I have to manage. So let's take a look at, for the first time, so Nordstrom's. What would you imagine, just for giggles, if, like, so Nordstrom's is a publicly held company, they probably, just making this up, but they probably do a couple $100 million, maybe $300–400 million of sales a year. They're all over the country. How would you break up managing that company? I mean, if you were the CEO of it, what would you do? Okay, you might have it managed geographically. Great comment. How else? Anybody here ever been in a Nordstrom's? Yeah, you guys are like, yeah, no. I don't make shopping trips to Spokane to go to Nordy.
They're like the Nordstrom Rack.
Exactly. Good. So they're called product sectors. So if I was running Nordstrom's, if I was CEO of Nordstrom's, and you guys were my top 10 employees, I might have each of you manage a product line. You know, your accessories and your lingerie and your kids' clothes and et cetera, et cetera. Okay. So net sales minus cost of goods sold is gross profit. Look at these numbers just for giggles and tell me one thing about these numbers. Net sales minus cost of goods sold gives me gross profit. How do you feel about that? You feel pretty good? Okay, why?
So net sales is the revenue of expenses that cost sold, and
Gross profit, different thing.
And then you just minus that. All you're doing is
Subtracting. Yeah. Okay, calculate for me, get out your calculators and tell me what my gross profit margin is. What percentage of my revenue is my gross profit? What percentage of my revenue is my gross profit? That's called gross profit margin or gross profit margin. I think it's going to be closer to 30 something, isn't it? Oh, I think that's, huh? Let's see. What happened to this guy? I think, let's see, utilities, calculator. What was the number again? What was my gross profit? Oh, you guys don't have it either. Okay, 5592, right, is my gross profit. Okay, 5592 divided by 15524. 15524. 36%. So can you just guess, I mean, just using estimation, if my gross profit margin was 36%, what percentage of my revenue did I spend on my inventory? Yeah, the rest, 64%. If my profit margin was gross profit was 36%, by nature, that means that 64% of my revenue was spent buying my products. You with me? Some industries have tiny little razor thin margins, like groceries, like vehicles. Making a living in auto sales is all about volume because they're just, especially now with all the, oh, I don't even know what you call it, but it's like the online, the digital buying where you can actually get the sheet of the car and see, you know, see everything on it. Razor thin, okay? And then some like retail stores, like clothing, have pretty lucrative margins. So that's why everything's perpetually on sale because they've already marked it up so much, right? Okay, so what's the game in merchandising? Here's the scoop, and this is really the whole game right here. I start with some cash, right? I've invested. And let's just go to a little store, back to my little open roads bicycle. Couple guys leased some space on Orange Street, bought some bikes. I mean, they were here when I was in college, which was in the frickin' 80s, okay, long before most of you were ever even close to born. So they took some cash and they went down to Las Cruces and they bought some bikes. And then they sold it, and some of them were on account. Some of them were for cash, but some of them were on account. That turns into accounts receivable. And then they got to get the money from the accounts receivable to go buy more inventory, don't they? This is called the cash cycle or the cost cycle in a merchandising firm. And for every time that you can follow a dollar through this cycle, profit margin is generated. So the quicker you can do this cycle or the more times you can do it, it's called turnover, the more profitable you're going to be. And I don't care if you're selling John Deere tractors or microchips or bicycles, that model is exactly the same. Turnover. It's called turnover. Okay, so let's start talking about what some of these models look like. And this is where the focus, I mean, I want you to see the macro, but we also, because it's an accounting class, we need to understand how to account for this. So everybody agreed that inventory is what type of account? Yep, and now when we say assets or liabilities, you also have to say what? Current asset. It's a current asset. What kind of account is cost of goods sold? It's an expense. And we just saw that, right? Here, because it was on the P&L, wasn't it? Cost of goods sold is the biggest expense in a merchandising company. Exactly. So the question was, Veronica, is this where the cost of the bike? So he paid $600 for it. I paid $1,800 for it. The $1,800 is up here in net sales. The $600 that he bought it for from the vendor is down here. And obviously that bike yielded him a gross profit of $1,200, right? So I just want to put this down so that you understand this. This is pretty important to put in your notes. Okay, so cost of goods sold is this new account. It's an expense account. So draw 2 T accounts for me. The first one's called merchandise inventory. Merchandise inventory. And the second one's called cost of goods sold, and I'm just going to abbreviate that from now on as COGS. Okay, so let's write underneath them again what type each is. What's merchandise inventory again? Current asset. Do I close current asset accounts at the end of the month?
No.
Do you close balance sheet accounts ever? No. So this goes from period to period, right? It just carries over. Obviously, at the end of the month, the bicycles that are all sitting there don't just disappear. Okay, cost of goods sold is what again? An expense. And it shows up on my, which account or which statement? P&L, right? And it's the number one always largest expense in a merchandising company. Okay. So realistically, I'm going to start out with some sort of beginning balance, aren't I? Right? Because we know we don't close asset accounts. Then what am I probably going to do during the period? I'm probably going to purchase some inventory. Okay. The example I gave about open roads, I made it sound like just once a year they go down to Las Cruces and buy all their bikes. That's not how it works. It's like right now, obviously they're bringing in all their winter riding gear.
Actually, they are bringing in right now.
They're probably too late. Thanks. Good point. I'm sorry, what? Beginning balance. Oh, number one largest expense in a merchandising company. What, you can't read that? It's like scroll. Okay. So I start out with my inventory. And yeah, Jen's right. I'm probably actually right now purchasing spring stuff. My winter stuff's been in there for 6 weeks. And then as I go along, I'm selling some stuff. When I sell it, it moves into cost of goods sold. It moves from the balance sheet to the P&L. Do I move it to the P&L at what I paid for it or what I sold it to my customer for? That's where this gets tricky. Dylan, you're shaking your head no. Exactly. That was how I introduced this whole topic. My first thing that we talked, or that you and I talked about, was, oh my gosh, I'm selling a car. I paid, you know, $6 grand for it and I'm selling it for $8. What amount goes in the revenue? $8. What amount goes in the expense account? $6. What's the difference between the 8 and 6 is called your what? Gross profit or gross margin, interchangeable terms. So this is circling all the way back to what the first thing I said was, which is you, every time you make a sale in a retail organization, you have 2 journal entries. You got to book the revenue and you've got to book the cost of goods sold. And those are 2 different numbers. If you're buying and selling something for the same price, you ain't gonna stay in business very long.
So it's like, if it was on its own, it'd be the profit, balance out of that.
Great question. So Andrew's question was, if I'm journalizing this and oh yeah, we're gonna have plenty of time to journalize. If I'm journalizing this, do I enter the gross profit? Can anybody see that and help him out? Is there gonna be an account called gross profit? No, why not, Hayden? Where do you think it's gonna go?
You don't need that, so.
Okay, you're going in the right direction, but you didn't really finalize it. Yeah, so you've got, so the question was, is there a gross profit account? We're trying to unpack that, Veronica. And Dylan said, okay, so you've got your revenue account, which shows the 8 grand you sold the car for. Perfect. What's in the cost of goods sold account? What I paid for it. So the 6,000 bucks that is there. So revenue minus cost of goods sold is the 2,000. I don't book the gross margin. I don't use an account called gross profit or gross margin. It's just right there, isn't it? That makes sense? Go ahead. No, keep asking questions. We're going to talk about this a lot more.
Are they tracking each individual item?
Yes. So Jen's question, just so you're tracking this. How about microchips where there's trillions of them?
So you've got 10 pairs of
Shoes.
boots,
Okay.
right? And let's say the company we got them for says, okay, you buy pairs and get 2 pieces of them.
Sure. Sure, sure. Yeah.
So are you tracking that price on your cost of goods sold?
Yes.
Or you're like, okay, this particular dish, and then
Yes.
you have a piece of tissue,
Yes. Okay, let me state the question for Veronica and then tell you guys how it works in the digitized world. So Jen's question is, I run the accessories department for Nordstrom's all up and down the West Coast, and I buy 10,000 pairs of Michael Kors boots. And within that product line, there's 10 kinds of fall and winter boots. Her question is there a cost associated with each pair of boots that goes out the door? And the answer is absolutely. The system that we use to track that in the 21st century is called RFID. And it's basically where we tag, we attach a rapid inventory tag to every single thing that flows through our system.
When you're doing a volume and they're like, oh, since you bought 10,000.
Sure. And then you just divide it by 10,000 and 20 pairs rather than 10,000. Yep, and it's all very sophisticated. We're also using a lot of the same technology that cryptocurrency is based on to track our inventory. In the old days, it'd be like we counted 1 phone, 2 phones, 3 phones, right? Now it's just all digitized. But yes, that's exactly how it works. Okay, any more questions in general? So this is, you can see where the complexity comes here. Okay, now see if you can track this. So now during the month, I've started with some inventory. I've purchased some more, and I've sent some over to cost of goods sold to my P&L, right? So it's moved from my balance sheet to my P&L. Can you see what's left in my inventory account, what that's going to be called? Yep, that's my ending inventory. And that's the number that's going to go on my balance sheet. And then guess what happens in the next month? That's my beginning balance, isn't it? And the whole cycle starts over again. The key here is that every time You make a sale. And you can be in a hardware, I mean, most of you probably don't do this, but I mean, like an Ace Hardware, they still have the old fashioned drawers where you go in and you need like 2 3/8" nuts. And I mean, just really super specific things. And then you bag them in little brown bags and you write the code on them. And some of them are like 3 cents each. Every time that gets swiped in Ace Hardware for 3 cents, what happens? Thank you, Lisa, for your 3 cents. At the same time that that happens, can anybody see what the journal entry is going to be to pull that wing nut off of the books? Yeah. You got to credit your asset because they just sold it to me. And what's it going to become? Yep. And every single time, whether it's a yacht or a wing nut, those 2 journal entries are made. I got to record some revenue and I got to record some cost of goods sold. And the difference is my what again? Gross profit. And that's got to cover all the rest of all my expenses and my net income. So I hope I priced that thing right. And if all of a sudden they cost me a whole bunch more than a penny to buy, what do I have to do? I've got to sell it for more. Okay. This is the eternal conversation that economists are having. We can't get people to work for 12 bucks an hour anymore because they can't pay the rent on that. So we pay them 15 bucks an hour at Taco Bell, which makes everybody else worth $20 to $22 an hour. So now you can pay the rent in Missoula, but the guy that's selling you a cup of coffee is like, holy shit, I can't sell you a cup of coffee for 5 bucks anymore. It's got to be 7, right? Do you see what that circular conversation is? When you have an economy that doesn't have outside influence, we could all have lived just fine on $12 an hour in Missoula, Montana. But when you have outside influence, which is what globalization is, right? And particularly now with outside developers coming in, oh my God, you're lucky to pay rent on 20 bucks an hour. So it's just, I mean, it's a very, and it's kind of, yeah, it's very surprising to me. A lot of people are like, oh, it's a president or it's this or it's that. It's like, oh my gosh, have you ever read, like, do you understand Econ 101? Or my personal favorite, oh, gas is going up because of the president. But where does our gas, how do our gas prices fluctuate? What do they fluctuate based on? Yeah, so is that really anything to do with targeted production here in the United States? Yeah, we have a big stockpile of fuel that we can draw from for any point in time. It's what is Saudi Arabia doing? What's OPEC doing? Norway, nobody thinks of Norway, #2 oil producer in the world. What's happening in Venezuela, right? So, I mean, it's so many external variables. So it kind of cracks me up when people like really simplify it because it's not simple at all. Okay, so there's 2 kinds of inventory systems. To be honest, we used to use the periodic system, which was, like I said, at the end of the period, you go in and you count how many, bikes you have left, and then you make journal entries to bring it all into balance. That's not how it works anymore. It's pretty much all perpetual. And I just showed you that every time I make a sale, I credit sales revenue and I move my inventory from merchandise inventory off the balance sheet into the P&L. All right, so let's just start making some entries. So take out a piece of paper, set up a journal. And I weirdly wrote all over what I was going to use. Oh, shit. Okay, well. Huh? Yeah, thanks. Nope, I'm good. Thanks, son. Okay, so let me just get a couple of these lined out here. Okay, all right. So let's start by, I'm going to put the transaction down here, and then we're going to make the journal entries up here. Okay, so the first transaction is, what's something interesting? What's my company? What do I sell? Boomerangs. I lived in Australia. I love boomerangs. They were the world's first hunting instrument. That's how they got flying animals, also known as birds. So cool. I purchased 200 handmade boomerangs. What made you think of that? I actually have a couple really beautiful artesian boomerangs in my house. Okay, I purchased 200 handmade boomerangs at $100 each. Oh, sure, sorry. On, what's today, 10/26? Okay. On credit. So I've got a guy in Sydney I deal with. I've got a high-end Pacific Island shop in San Francisco. Australia's kind of cool. Everyone's into it. So I buy 200 of these for the Christmas season. Book the journal entry. What do I debit and what do I credit?
$100.
Yeah, they're art. It's an artistic piece. It's not something I'm actually going to go out and like goose in the net with. It's art. I've got it displayed in my home and in the Pacific Island art. You're missing a piece of the series. It's art. You know, they're way, way, way harder to use than they look.
Yes.
But you know what else the Aboriginals did to get waterfowl? Is they would set up a net on a river, right? So their rivers are pretty, you know, very treed and dense. They'd set up this net and then they'd swim towards them and scare them. And then they would all just fly into the net and then they'd kind of be stunned. So then they would come underwater and grab their legs and drown them. A pretty efficient way to get a bunch of waterfowl. It's like 10,000 years ago, you didn't have a gun, what'd you do, right? Okay, so fun facts about Aboriginals. 10/26/21. I'm going to debit merchandise inventory. Is that 2,000? No, 20,000. $20,000. And I'm going to credit accounts payable. Okay. But here's the scoop. We have to now learn about something called terms. My dealer, my art dealer in Sydney, deals with all the high-end artisan shops around the country that deal in Australian and New Zealand and Pacific Island art. And he doesn't want to wait 30 days for his money. He wants to entice me to pay earlier. So he says the terms, I'm going to give you terms, Lisa, and the terms are 210 net 30. And that's just printed right on the invoice, 210 net 30. That means if you pay within 10 days, you get a 2% discount. 210, but in any situation, you got to pay me in 30. So if you want to take advantage of a discount, you will get 2% if you pay me in 10 days. But net 30 in any situation, you've got to pay me within 30. Now, right off the get-go, when I remember that cycle I showed you from the cash cycle, What is any good manager going to want to do? They're going to take advantage of this discount. Okay. If you don't have the cash flow, you can't take advantage of it. But if you're managing your working capital appropriately, you're absolutely going to take advantage of it. So I pay my invoice in 8 days. So B, pay invoice on 11/2. Now, this takes some thought, doesn't it? I'm not paying that full 20 grand. So your credit to cash is for the amount I write the check out for. But the accounts payable has to come off the books at whatever I put it on at. The difference is a reduction in the cost of my inventory. No, right now we're just still doing, really it was what Jen was talking about. If there's some sort of deals with the raw price of the inventory. And this is a very, very common deal. So first credit cash for how much you think you wrote the check, or I wrote the check for. The accounts payable has to come off the books at what it's sitting there at. And the difference is a reduction in the cost of inventory. So did I pay him $20,000? No. I got a 2% discount. So what did I write the check for? That's correct. So on 11/2, on 11/2, I wrote a check for 19,600. And that's always what I figure out first, even though it's my credit. What's my debit to? What's one of my debits? Okay, this is the key here, you guys. You always have to pull accounts payable off the books at what you put it on at. Otherwise, you've got just this weird nonsensical amount out there. How much did the AP go on the books at? 20 grand. What do you have to pull it off at? 20 grand. Do my debits equal my credits? No. What's my last credit to? Of course, my inventory didn't really cost me 20 grand, did it? Now, set up the T account for inventory and tell me what you think each boomerang's cost basis is. Set up your merchandise inventory account. Post in these two little, and I want to know the per unit cost basis of these boomerangs, which is where Jen was going before she really knew where she was going. Post in your two transactions and divide by the number of units I've got sitting there and tell me how much I've got into each boomerang. If nothing else had happened. Okay. Where's my calculator? That ever drive you crazy? $98. I didn't pay $100 for each of them, did I? And that number should make sense, $100 minus 2%, right? Okay, now what am I gonna do? It's Christmas time, I'm gonna sell them. And this is a very elementary example because with art, they're gonna be priced all over the place depending upon what tribe they come from. But let's just say that I'm selling each of them for $450. They come on a snappy little stand. So you come in, you walk in and you're shopping in some trendy little place in the Mission District in San Francisco. And you're like, oh my gosh, I love these. I am buying one for me and one for my sister. And let's just make this one easy. This is for cash. Now, slow down for a second and remind me how many journal entries we always have to make when we make a sale. Dos. So record the revenue. Just take care of that. And then record the expense, i.e. moving the inventory into cost of goods sold. 2 journal entries. Oh, thanks. The date on that is 11/14. Okay. So what's my first journal entry? Debit what and credit what? Anybody? Debit cash and credit. Sorry. Nope, I'm recording the revenue first. And we just call it sales revenue. $450 times 2. $900. Great. Okay, fabulous. But what do I have to worry about simultaneously? I've got to pull 2 boomerangs off of my balance sheet. They're no longer sitting in merchandise inventory. And I got to move them on into cost of goods sold. And we just did the calculation as to how much cost basis is in each boomerang. So that's the amount you got to pull it off at. There, now I'm making my second journal entry. I mean, you can put them together, but that's way more hard to process, I think, in your mind. Oh, no. Debit cost of goods sold. Credit my asset account. What's the number? What times what? 98 times 2, because remember up here we found the per unit basis. Is that 196? Now tell me what the gross margin is, also another word for gross profit, on that transaction was, so in actual dollars. And then also tell me what it is in percentage. So calculate the gross profit or gross margin in dollars and in percentage, please. So 900 minus 196. My gross margin on this transaction was $704. And the percentage is divided by the sales. So that's a really pretty high. 704 divided by 900. So for every boomerang I sell, 78.2% of the sales price is available to cover all of the other expenses and yield a net profit. Now, I don't know anything about the high-end art world, but I would imagine that you want a pretty big profit margin in it because there's not a lot of players. Right? If you were selling boomerangs like you were ammo, this would be a much, much, much tighter profit margin. Okay. All right, let's go and just kind of look at these now, and then I'll tell you what I need you to do for Thursday. Okay, we're taking this in little bits and pieces. This is exactly what I talked about. The seller can grant a cash discount to encourage buyers to pay early, which is what they did. Hey, Lisa, if you pay in 10 days, you get to take 2% off. That's called credit terms. This could say 315 net 30 or 312 net 20. I mean, you can set up the terms any way you want, okay, that are agreeable to both parties. It's on the invoice somewhere. Where do I see it? Right here, terms, 210 net 30. We need to talk about one more thing here. This is the last new piece of content I'm going to give you today. FOB stands for free on board or freight on board. And when you buy and sell merchandise, as you can imagine, part of the negotiation is who's paying to ship it. Okay. FOB destination means the shipper pays, the seller. FOB means that the seller pays the freight. So these boomerangs came from Sydney to my shop in San Francisco. They're prepaid. I don't pay the freight if it's FOB destination. The other thing that could be here is FOB shipping point. FOB shipping point means that I do pay it. The buyer does pay it. So what just happened to the cost basis of my boomerangs if I had to pay for freight? They just went up. Okay, do you see how this can kind of get complex? Oh, that's what we just did. We just did that. Okay, let's take a look at what I want you to do for Thursday. So in chapter 5, go ahead and read through page 174. Okay, don't read it all because I just want to take this in bits and pieces. So read through page 174, please. And then on page 194, you're gonna do QS 5-4 and 8, QS 5-8, QS 5-10. Now I'm down here. And 11 and 12. So 4, 8, 10,